What exactly is DeFi? This is an acronym for Decentralized Finance. We have always used centralized finance, which is where a central authority controls the flow of money, such as the government and banks. They don't actually say it, but they can print more of it if they want to. If they don't want you to borrow it, they can stop you and even prevent you from opening a bank account if they desire so. They could have your money at any time, so they could change it and you couldn't really argue with it. But maybe you could, but how could you exactly prove it? You gave them your money on the basis of trust, and also if you own a business, they limit your options. For example, if you have a small magical tree business that may be used for medicinal purposes, they may tell you not to bring any of the money from the business into the bank, severely limiting your options. It means you can't deposit it, invest, or even keep it safe. Furthermore, traditional finance is quite costly. Payday loans can cost up to 500% of your value, credit cards can cost up to 25%, and personal loans can cost up to 18% of your value. These are extremely high rates, but you must pay them if necessary because that is what you have. The alternative is decentralized finance, in which there are no banks but instead pieces of codes that run and function as banks. They are open to anyone, and you don't have to trust them because they're just a piece of code running a program. If you wanted to, you could go through it and make sure it's not a scam. They are also resistant to censorship, and they are significantly less expensive than traditional centralized finance, which we are accustomed to. Finance is founded on three pillars: cryptography, blockchain technology, and smart contracts. So assuming that you're familiar with cryptography, blockchain technology, and smart contracts, let's dive into the 5 pillars of decentralized finance. Number 1 is stablecoins. So first and foremost, we must comprehend the bridge from decentralized finance to centralized finance, which is cryptocurrency linked to a real-world asset. Tether, for example, and the USD coin are all examples of stable coins. This is because their value is linked to the US dollar. Consider this. When you buy one for $1, a new US dollar coin is minted. When you withdraw one, a US dollar coin is burnt. As a result, the coin is always worth $1 US. The goal of this is to have a reliable way to buy and sell specific coins without having to buy and sell them. Instead, we can simply trade them. Here's an example of why this might be advantageous. Assume you paid $500 for one Ethereum. Now it's $1,000, and you want to sell because you believe it's too high, and you want to take your profits without stable coins. You must sell your Ethereum at a centralized exchange such as Coinbase or Binance, and they will reimburse you in US dollars. Of course, they'll take a cut of that transaction because they want a fee and they'll take it. Also, the IRS requires you to pay tax on any profits you make from trading or selling coins on Coinbase, and Gemini will be snitching on you so you won't be able to avoid it. The next step would be to wait for Coinbase or Binance to transfer them to your bank and then withdraw them because you don't want the bank to have control over your money. Well, a month later, Ethereum falls to $250 and you want to buy more. So you will have to deposit your $1,000 back into the Coinbase. Now wait a few days for the transaction to clear because you have to wait and then buy and hold Ethereum. When Ethereum reaches $500 again, you will then decide to sell it at your centralized exchange, pay the fee, and wait a few days for it to arrive to your bank account. In this example, there are a lot of fees, taxes, and waiting. Instead of going through all of the trouble, let's say we use a stable coin like USDC and you bought one Ethereum for $500 and it rose to $1,000. You exchange one Ethereum for 1,000 USD and hold it for a month, as in the previous example. It falls to $250 and you exchange your 1,000 USD for Ethereum, at which point it rises to $500. Within 5 minutes, you sell your Ethereum for $2,000 with fees of less than 1% because you traded on what we call a decentralized exchange, which we will explain later on. However, because of it, you were able to trade almost instantly, and the USD was secure, so you trusted it because it was just a code. It does not change, unlike Coinbase, Binance, or Gemini, which are under the control of the government, and more importantly, the people. So the purpose of stablecoin is to allow you to participate in the crypto sphere without having to use your government-owned bank. Banks are taken for granted in many places, including the United States. But some countries severely restrict how much money can be moved around or what currency can be purchased with. In fact, in the United States, any transaction exceeding $10,000 must be vetted and approved by a bank while using a stablecoin such as USDC. You can move $10 million from one address to another for a $5 fee. You could never do that with US dollars. Number 2 is lending and borrowing. Lending and borrowing are important pillars of decentralized finance. Indeed, a large part of the world's current financial situation is based on lending and borrowing money. So it stands to reason that the blockchain could do it better. One of the reasons we can reliably lend and borrow with banks is that we usually put down something like 20% collateral, so that if we do not repay the entire loan, the government can come after us and imprison or fine us. In short, there are legal ramifications for failing to repay a loan in a timely manner using cryptocurrency. This is a problem because anonymity is one of the benefits of crypto. You could put down $20 and walk away with the rest of the loan, never to be seen again. So we need to find a way to solve this with smart contracts. We can actually give others access to our funds while keeping custody of them. So for example, if person A wants to earn interest on his coins and person B wants to borrow some coins, person A goes to Compound or Aave, which are two platforms that allow crypto borrowing and lending, and person A deposits his coins into a smart contract. If you don't already know, smart contracts are simply code that runs a specific function in return for C tokens or A tokens that are a representation of his original coin plus interest. Whenever he wants, he can simply turn his A tokens or C tokens into that smart contract that was created by compounder Aave, and they spit out his original deposit plus interest. Now the smart contract is designed in such a way that no human being is required to perform the calculation or the transaction. It's all automated by code. So if person A wants to earn interest by lending in the traditional way, person B must do something in the borrowing portion. Person B must do over-collateralize his loan. This means that if he wants to borrow $100, he must put up $100. So that if he runs away and never repays his loan, the smart contract is written in such a way that it can pay back the person's coins plus interest. At this point, you may be wondering, what's the point of taking loan if you already have the money? You're probably thinking in US dollars. Say you have 10 Ethereum worth $1,000 because they're each worth $100. But you don't want to sell them because you believe strongly in the Ethereum project. So you put them up as a collateral and borrow $800 in Tether, a stable coin pegged to the dollar. So you trade that $800 around, making some money, losing some money, making some more money, and now it's time to pay back your loan. So you have $850 in Tether and pay back the original $800 loan to get your 10 Ethereum back. Well, in this example, you made $50 from the small trades you made, and you got lucky, but it has also been a few months in Ethereum, as it has done in recent months, has exploded and they are now worth $150 each. So you now control $1,000 plus the $50 you made trading. Basically, if you believe in Ethereum and own it but don't want to sell it and want to use the value of it, you can take out a loan on it in the hopes that it will be worth more than you cash it out. However, if you traded and lost some money, gained some money, and then lost some money, and ended up with $750 in Tether, you have two options. Option A is to front the extra $50 to pay back the full loan, the $800, and get back all of your collateral. And option B is to keep your $750 and lose your 10 Ethereum, which could be worth a lot. Now, this may be information overload, but there is a second type of loan in crypto called a flash loan, which is a loan that lasts for about 10 seconds if you buy Ethereum for 10 on Coinbase and sell it for 11 on Gemini. You can theoretically make $1 for each of this if you do this one. So you can use what we call a flash loan to borrow millions of dollars. You don't have to put any money down. Simply write a flash loan to borrow $10 million instructed to buy Ethereum for $10 and immediately sell it for $11, and then repay the original loan in 10 seconds, all in one small smart contract that runs in 10 seconds. Essentially, you made $1 million minus the fees for borrowing, but these fees are small because the lender knew you would have to pay them back and that it would be a very short period of time. This is a more advanced technique, but this type of arbitrage would never be possible in traditional finance. Decentralized exchanges are ranked third. Instead of a foreign exchange trader, we have what is known as a decentralized exchange where you can exchange your coins and tokens for other coins and tokens as well. Now the fees are usually very small, like less than 0.5%, which is a great benefit for anyone who wants to trade their crypto assets on a regular basis. Most popular decentralized exchanges or DEXs works in a way where investors pool their money together and then traders can trade that money. The fee of every trade that I mentioned earlier goes back to those investors and it's all written in code. So they don't change and can't skyrocket in value like 15 decentralized exchanges do. For example, Coinbase, the first centralized exchange to go public, only allows you to buy and sell 32 cryptocurrencies at the moment because they are regulated by the government and must follow certain regulations. They carefully examine each coin before adding it to the most popular decentralized exchange, known as Uniswap, which has hundreds, if not thousands, of tokens to trade and is not regulated by anyone. Now that is the decentralized part. There are billions of dollars locked up in these liquidity pools so traders can trade, but nobody has control over these billions of dollars. They are simply following a program written by someone. In fact, only investors can withdraw their money from the pool. However, if they did, lending rates would rise, causing new investors to enter the market. So as I previously stated, the code cannot be changed. It is immutable. In the crypto space, we like to say that the code is the law. The government does not control it, everyone has access to the code, and it does not change. Uniswap is one of the major exchanges in the Ethereum network with billions of dollars in its pools. PancakeSwap is another exchange on the Binance Smart Chain network with a few $billion of liquidity. For example, you pay $100 per month for car insurance to protect your new Tesla. Well, one day, while using your autopilot feature, another car causes the autopilot glitch and you drive into a ditch unharmed. But you completely wreck the car. Since you paid insurance, the insurance company pays you the value of the Tesla so that you can go buy another one. They use statistics to predict how many of their drivers will crash their cars and then use this data to predict how much they would have to pay each year to determine what the monthly price of the insurance should be, which is also known as the premium. To connect the actual world to the blockchain, we must use oracles, which are reliable sources that act as a bridge between the real and crypto worlds. We can build an oracle in our city that reads the temperature and is confirmed by a few people to ensure that it cannot be manipulated. And then the smart contract may use it as a data source to determine whether or not insurance criteria are met. Second, the $100,000 comes from other people buying insurance who paid the premiums but did not get paid out because the requirements were not completed. Much as an insurance firm makes money from people who give liquidity to any decentralized finance platform, may be incentivized within an interest rate to earn their deposit. In other words, portion of the $100,000 may come from investors who gain money by lending their money. Finally, we have number 5, which is margin trading. Let me quickly describe margin trading in the traditional world, and then I'll explain it in the decentralized world. Say you want to buy Apple stock and the price is currently $100. Margin is effectively a loan that will automatically sell your stock if the price falls below your down payment. A $100 loan is required to purchase a $100 stock, and the bank agrees to provide that loan in exchange for a $20 down payment and a 5% annual fee. So here are two situations that could occur. The stock increases from $100 to $150 and you have paper hands. So you decide to sell the stock for $150. You pay back 80% of your loan because the bank already had your original 20% as a down payment and you keep the remainder, which is a profit of $70. So you practically made $70 by investing only $20. This means you have more than tripled your money even though the stock only increased by 50%. This is the power of margin. Use it when you believe something will improve in value to multiply your own money. Now this is the second scenario, and it is if the stock drops to 50%. With margin, you actually have to sell as soon as the value of what you bought can't pay back your loan, so that the stock starts out at $100, then it starts dropping to 90, 85, and then as soon as it hits 80%, boom, the bank forces you to sell your own stock of Apple at $80 so you can pay back your loan. So the $80 you made by selling the stock, plus the $20 you gave them as a down payment, equalizes the loan. And the bank now has the original $100 they granted you, so they are free and clear, but you didn't benefit anything from it. Now, in reality, you lost the $20 you put in as down payment in centralized finance to trade on margin. To even have access to margin trading, you normally need to be able to prove who you are as well as having a few $1,000s. The costs are also considerably higher than 5%, and decentralized finance margin trading can be a lot quicker, open to anyone in the world with money, and a lot more safer as well. So to summarize, we've covered 5 major pillars of decentralized finance. First is stablecoins, second is lending and borrowing, third decentralized exchanges, fourth insurance, and fifth margin. And that's it for this video. If you find this one informative, give us a huge thumbs up and subscribe to our channel. Also hit the notification bell so that you could get updated whenever we upload a new video online. Till next video!